Hi, welcome back. One of the interesting things about teaching accounting is trying to make that connection to our everyday lives. And today I want to do that through your debit card. There is an accounting reason why we have a debit card at a bank, and it actually has to do with the rules of debits and credits. So without further ado, let's take a look at it. One of the things I want to do today is to talk about something that we all have in common, I would say. And this is a fun little illustration of accounting principles of the rules of debits and credits that I think, once you start to sort of think through what I'm about to tell you, this will help you to start really understanding what debits and credits are all about. So, why do you have a debit card? The reason that you have a debit card is because of these accounting rules of debits and credits. And one of the things that we're going to talk about a little bit today is about perspective. So from your perspective, for you, a debit card represents your checking or cash account at a bank. And for you, this checking account is an asset. So if you were keeping your own set of books, if you were, doing accrual accounting and all that sort of thing, then you would show your cash account, your bank account, as an asset. However, we want to look at this from the bank's perspective. So for the bank, your checking account is not representing an asset. It actually represents a liability. So when they take your cash, they actually put that in cash reserves on hand, which is an asset, but they also, as the other side of that, they credit a liability account. Therefore, the reason it's a liability is because anytime you can go in and demand to take your money out of the bank. So if you've put $1,000 in there, if you walk in tomorrow and want to take it out, they have to give it to you. So then they no longer have access to your cash, and they would have to take that out of their liabilities, and they'd have to take that out as an asset too. So think back, if you have looked at any of the debits and credits rules videos that I've been doing on this channel, you will find that anytime we use a liability account, the normal balance is a credit. So to increase that liability, it is credited. So when you think about your checking account, that liability increases when your employer deposits your payroll check, as an example. So if you go out and look at, for instance, I bank with Chase.com. So if I go out to Chase.com and I pull up my lovely checking account, I can see that anytime payroll is deposited in there, it's actually a credit to my account. However, when I decrease my liability with the bank, it is debited. So thus, that's the reason you have a debit card, because every time you use it, you are decreasing that liability that the bank owes to you at any time you ask for it. So here's an example of if you were to go out and look today and pull up your bank's online list of charges and all that sort of stuff, you'll see that if you have a payroll line, it's on that credit side of the ledger, if you will, and then your debit card purchases are on the left. So it follows the rules of debits and credits like any other account that is associated with a normal balance of a credit. But that is because it's from the bank's perspective, because it's the bank that's actually holding on to your account, and so on their books, your cash that you've given them, yes, they have the cash, but also that checking account is being represented by a liability account on their books. So therefore, when we look at debits and credits and all that, from the bank's perspective, that's why we have a debit card. So I hope that helps in helping to explain or give a slightly different perspective on debits and credits from a real world, real life example that you use every day. So thanks for listening, and I'll talk to you soon.